Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position along with your favorite beverage to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Alan B., Michael N., Nick W., Dave V., Jackie A., and Jeff S. On the program today is a returning guest. Justin Huhn has joined us. Justin is the founder of Uranium Insider, a dedicated uranium market research letter that provides actionable commentary and analysis of the uranium market. Justin is well known within the uranium community, has established a good network and understanding of the inner workings of the market. You can learn more about Uranium Insider and their service via their website, uraniuminsider.com. Mr. Huhn, welcome back to the podcast.
Andrew, it's great to be back. How are you doing?
Yeah, good. Good to be back with you chatting. Things are, of course, busy, whether it's uranium or somewhere else or just paperwork pushing. So, how are things with you?
Things are really good. It's very, very volatile markets right now. Very difficult markets, but a lot of stuff we can cover. A lot of moving parts that are quiet but seemingly kind of gaining some steam, sort of in the background. And just today, the market's moving pretty significantly. The uranium shares, anyways, on news that there's a renewed Section 232 investigation that's going to take place in the United States, which we can get into. But these are these quiet times during the uranium market. If you have the conviction that we have on the mid and long term for this trade are very, very good opportunities. And we've had plenty of opportunity over the last 6 or 8 weeks to accumulate extremely cheap shares as the baby's just been thrown out with the bathwater. So all good moving into the spring, and a lot of moving parts, a lot of things setting up very nicely for this investment.
Looking at this, Justin, of course, we took a well-known position among our membership that we needed to lighten up on shares. This was luck with a little bit of intuitive thinking here, just as far as how we see the broad market. And we lightened up and went more towards cash. And it wasn't just in uranium, it was everything. This was done throughout 2024 on our side. And again, we actually did do this, but it was anybody would have to tell you it was in part some reasonable luck just on thinking of how the market's going to start to move maybe the wrong direction or just too many cracks at the foundation of the broad market to be comfortable. The whole premise of what I'm saying here is the broad market has dictated all of our little junior sectors this year. Obviously gold, the price itself for physical gold has done well, but even the little juniors in the gold market, short of company specific successfuls out there, which there's a number of them, the junior shares are still way off, barely responding to the gold price environment. With the exception, of course, there's always a company or two out there or a handful of them that are doing well. I think the market still yet started to provide some opportunities, Justin. There still may be very well lots of opportunities this year that the broad market will give us in the uranium sector. I do think that once the broad market is able to sort itself out, which the time frame is undetermined, I think people have to look at this as well. And trust me, we've all been burned for sure, and we've all lost money, or at least on paper anyway, this year. There's no doubt that that's happened. I don't think anybody has been fully spared. Some people have been better positioned. There's no doubt about that. But I also look at this as a blessing yet again in the uranium market, and we've seen throughout the years occasional blessings to take a look at maybe adding to some positions. Not saying that you have to do that right now in current prices in terms of all in, but to be taking a few select positions as the market gives opportunities in the coming months, I think that makes sense. And that's an important piece of this. And so I look at it as well, everybody's been hurt to some degree. I do think that this is also a fantastic opportunity to buy some time, make some additions, participate in some placements that make sense, and take advantage of what the market's giving us. And so that's just my overall thoughts on, as to what you said. And then, of course, yeah, we should talk the 232 and some of the other stuff that's happening out there. But what are your thoughts just as far as how you're seeing things? I'm sure there's a handful of people that aren't liking you either, but this is what the market gives us.
Yeah, the market will be a humbling mechanism for anybody who is investing longer than a few months, right? It's these experiences, and we've been through very volatile periods since I've been following this market, which was all the way back in 2016. It's almost 10 years that I've been following the uranium market. So it's no, there's no real uniqueness to the manner in which these shares have pulled back. The frustrating part has been that the shares have been washed around largely with the broad market, like you mentioned, and we're sort of in unique territory on that front, right? It's extremely volatile. The market can move on a dime, up or down, in very, very steep moves for these large indices. You know, the S&P moving up or down 5%, even almost 10% up day after Trump's tariffs were pushed off for 90 days. And so, you know, a Trump tweet can move the market on a dime up or down in a violent manner. And that's a very, very difficult environment to invest in. And, you know, largely it's good to have diversification. It's good to have some cash. If you want to hedge with the market short, you know, all of these things that can be implemented, which I've done all, you know, over the course of my investing career, and right now having some cash, being short the market as a small hedge, being long gold, I think is really important. But seeing stocks, bonds, and the dollar all decline in unison is pretty unique territory. So it's just a very difficult period to know exactly what to expect for the short term. Now, the good part of that is that when you have an investing thesis like uranium, like gold, whatever it might be, that you can look at uniquely and step aside from the broad market and say, okay, let's talk about uranium specifically. Is the trade over? Is the quote unquote bull market for the commodity over? And that's something that you have to look at. And that's something that we have looked at, of course. And we have an extremely in depth set of spreadsheets modeling this sector. And we're taking the total reactor demand, which is relatively easy to model. We know what's operating, we know what's under construction, we know what's going to be operating 5 years from now with very, very high confidence. We can make reasonable assumptions for enrichment tails assays and know how much uranium is going to be consumed by the operating fleet. Now, going out 5, 6, 7 years, you go out past that, you have to start making more assumptions and start plugging in some numbers. For example, China absolutely will have some operating reactors in 2033 that aren't under construction right now. So you have to fill that in a little bit when you go out that far. But we know what's going to be operating with very, very high confidence in how much that's going to be consuming going out 5, 6, 7 years. Then you go to the supply side, and supply, while it's trying to respond and is in small volumes responding, is extremely reliant on a few very large projects that may or may not get built on time. And I feel like the supply side of the sector, Andrew, and tell me if you feel differently, but I feel like it's on a house of cards right now. That the market is absolutely necessarily depending on Arrow, Kazatomprom ramping to 80 million pounds a year, Phoenix getting built, DASA getting built. All of these things are extremely important for a quote unquote balanced market for a tiny point in time, you know, 2031 ish, whenever, if these happen on time, on budget. And it's highly, highly unlikely that any of these projects will happen on time. So, looking at that dynamic, looking at our modeling, which has been incredibly, incredibly helpful, we know this isn't over. And then you can look at just the evidence in the physical market. The term price has done nothing but rise. It pulled back $1 a few months ago. It's still sitting here at $80 a pound. So we've consolidated at $80 a pound for the last 7 to 8 months. But it's basically been rising without hesitation. The term price for uranium is absolutely in a bull market. The spot price has gone through very large fluctuations, big overshoots, a high amount of backwardation that we saw late 23, early 24, where the spot price breached $100 a pound, where the term price was still, 70, 72. And that, of course, came back down and has also been stable in the mid 60s for multiple months, despite the fact, Andrew, that last month, March of 2025, was the lowest volume spot traded month in over a decade. Last month, the utilities are in an impossible environment for long-term contracting run, making big decisions. And you have to consider how big these decisions are. If you want to contract, let's say, for 1 million pounds of delivery for a 5-year period. Now, even if you're going out for delivery starting in 29 or 30, you're still making those deals based on the present prices in the market right now. That's 5 million pounds at $65 a pound. You're looking at $300 million. Okay. Plus. So fluctuations on that pricing, while it's still a small percentage of the overall operating budget of a nuclear utility, to speak generally, it's still a huge amount of money. And when you have to make that decision, especially for a US utility in this environment, what is going to happen with the war in Ukraine and trade deals between the United States and Russia? How about these tariffs? Right now, there's a 10% tariff on Canadian uranium, a 17.5% tariff on Chinese uranium. Uranium is supposedly exempted from the proposed reciprocal tariffs that Trump announced 2 weeks ago. However, whether or not different elements from tariffs from different countries are going to affect future deliveries is still a big, big question. Lastly, is the Trump admin going to do anything to support nuclear in the United States? If they do, what does that look like for the fuel cycle? These are huge, impossible questions for a utility to make a multi-$100 million decision on in the term market. So it's causing utilities to basically just sit on their inventories, make small carry trade deals, make small purchases of EUP here and there, and just try to kick the can down the road a little bit longer to a point where they hopefully have some clarity. Now we have this Section 232 investigation introduced where the Trump administration is going to be looking into the critical minerals that are necessary for operations for infrastructure and energy in the United States, and whether or not the industry is reliant on foreign countries, especially adversaries. And we all know the nuclear industry in the United States is 100% reliant on foreign countries because we produce almost nothing. I mean, maybe we'll hit 1.5 million pounds in the United States this year and consume 45 to 50. So we're reliant on Canada, on China, on Russia, on Uzbekistan, on Namibia, on Australia, on basically everyone else besides the United States for uranium. We have some conversion, we have some enrichment, we have fuel fabrication. But on the uranium front, this is a big issue. So now the industry has to step back and say, okay, what's going to happen in 180 days when this investigation is over? Is the administration going to recommend or implement? It's probably not going to be something that increases supply and reduces price. So this element could actually accelerate the need to contract for US utilities. Either way, it's a difficult environment for them to operate in. It's a very illiquid market. Not very much demand coming into the term or the spot market is increasing the price. So all of that is to say we're in this extremely unique period where, from an outsider's perspective, it looks like nothing is happening, but there is a lot happening. And the broad market weakness and the spot price stagnation has given very, very poor movements to the equities and given enormous opportunities to anybody who can see past the next month or two and look at the demand growth picture for nuclear, the problematic supply picture for uranium, and have a mid to long term vision for this market, which we are extremely bullish on and see huge opportunity at these equities prices.
Very good stuff here. Probably more than we can cover off today with today's episode, but want to walk back for just a moment here and talk briefly about tariffs that would be applicable to the sector, whole fuel supply. In my initial view here, the tariffs aren't substantial enough to stop certain practices of procuring material, whether it's from a third party country or whether it's shipped and relabeled, what have you. You know, the origins can change. You can dick around with this. We've seen this before already happen. Do you think the existing tariffs are enough in the uranium sector, specifically on fuel supply, to discourage the practice of, continuing to try to secure materials in one way or another? Do you see that the tariffs would play a role going forward, or do you think this starts to get resolved under a 232 situation and the tariffs become less relevant as we go down the road here? Just what's your thought on, discouraging seeking out some of these other jurisdictions that are questionable and maybe they don't mind paying more money? What amount would be enough in your view to discourage them from doing so, period? And of course, that's going to cause a bunch of domestic problems, but what do you think about that?
I can't see any amount of tariffs actually keeping a nuclear utility from procuring what they need to procure to keep their operations going. I mean, unless
Agreed.
it's a 500% tariff or something like that. But that's not going to be across the board, even if that were introduced for every country. And there's multiple countries that are producing enough uranium that even if there is a tariff of 10% or 20% that sticks, they're going to have to buy it. They don't really have any other options. You're not going to shut down a $10 billion facility that just got a life extension to operate out to 2050 because you have to pay 10% more for the fuel. So, and 10% more on uranium is actually only 5% more for your entire fuel needs, right? Because uranium is about 50% of the total cost of procuring fuel. And the other elements, of course, conversion and enrichment, deconversion, and fabrication. So uranium is about half of that overall cost. So the big thing that utilities need more than anything is just clarity. It's not necessarily that they're worried about I mean, cost matters. So even though they have to buy at whatever price, they don't want to pay more if they don't have to. And regardless of when a utility will come into the market to procure, they're going to do what they can to pay as little as possible, as anybody does when they're buying anything, right? So that's perfectly natural. But the concern is not necessarily whether or not there will be a tariff from let's say the country of origin that maybe negotiations are currently happening between a producer in that country and a US utility. The question is not how much the tariff will be, but will there be a tariff, and when can I move forward with certainty about what that will be? Um,
Yeah.
there's other questions about, okay, the tariffs are introduced right now. What happens in 3.5 years when Trump is gone? Who's going to be in office? And that's probably the period of time, anyways, when those deliveries will happen. Will I be paying that tariff at the time of delivery? These are all just enormously complex questions that it's very, very difficult right now because Trump is kind of fast and loose with these policies. One day it's this, the next day it's that. How do you make a multi-$100 million decision on these policies? They just need clarity. With
Yeah.
all of that said, even without clarity, if the price starts to move up, and one day does not make a trend, but we're seeing some movement in price today, possibly in reaction to the 232 announcement after the market closed yesterday. But if we go from 65 to 70 spot and we see the term price jump up a dollar or two, we're going to see utilities come to the table. And this is one element that's very difficult for investors to really wrap their minds around, because especially resource investors are largely contrarian, wanting to buy low and sell high. With that said, there's always momentum chasers in every sector. But so understanding that utilities don't attempt to catch falling knives, they don't try to procure in large volumes when the price is pulled back 40%. Why don't they do this? Well, because they would rather sit idle in an uncertain market where the price is stagnant. But if the price starts to move away from them, then they get FOMO, right? They understand, okay, the price just went from 65 to 70. Now it's looking 71, 72, 73. Sellers that were in the market back in December, January are already gone. Who are the sellers right now? Do they start to pull back? And then all of a sudden you're off to the races, and you'll see utilities come in. Maybe they won't make huge, long-term, very large volume decisions in that environment, but they will come back in smaller, maybe medium volumes into the term and potentially the spot market via carry trades. So movement and price up will bring utilities in. Clarity will bring utilities in. How do I think the tariffs are going to settle out? Honestly, Andrew, I have no idea, and neither do the utilities. So they just need some clarity. With that said, a 10% tariff on Canada is not going to keep U.S. utilities from buying from Cameco, for example. The Chinese tariffs is 17.5%. That's likely to go higher, especially after this 232 investigation, because the Uranium Producers of America, I know that you speak with Scott Melby. They have highlighted this issue to the administration, that U.S. utilities are buying enrichment from China because China has been importing it from Russia. China does not sell uranium, but they will sell what they are able to import. So it's a complex industry, but all of that said, these guys just need clarity. And when that comes, we're going to see more volume come in.
The clarity thing is absolutely true. Okay, I'll come back to the clarity in just a moment. When you look at the environment for why you would use tariff, now there's more than one reason why you'd use them, but in this case, to promote domestic capacity rejuvenation, It's a painful way to do it, and there's actually not too many ways to do it that aren't painful. The ways that are not painful usually don't work. So there's got to be some pain brought in here, and that's part of this process. Let's talk maybe steel industry for a moment. The steel tariffs, that caused all kinds of disruptions, but it also provided a bunch of grifting opportunities as well, where domestic folks were playing off the tariff increases by jacking their own prices. And then, of course, the foreigners also did the same, depending on what you're talking about, whether you're talking about steel spools, rebar, what have you, different segments of the industry, different things happened. But certainly saw a lot of that happen just with some of the other things that we look at out there at the market. And there was obviously some funny business going on as well, where people were taking advantage of the tariffs and the uncertainty to basically not even guarantee quotations for 30 days or 15 days or even 10. It was basically next morning, mark to market, we'll change it. And so there was no commitment to pricing. So what it does is it starts to build the encouragement of domestic industry. Now, it doesn't happen overnight, but I do think the tariff approach can start to get folks going down the food chain in a sense, to where you look at new builds, you look at domestic capacity. How can we, incentivize people to work domestically to build out infrastructure and build out capacity? The steel industry is one example. The other example would be, too, in the uranium sector. I completely understand that utilities would be uncertain and there would be no decisions made on things. Now, of course, every utility is a little bit different. Their situation is different in the sense that some are more desperate than others. You well know there's utilities that bought stuff way back in the day, 20, 30, $40, and are plenty happy for the next 6, 7, 8 years, no problem. So you have a huge variance in situations. One of the things I do think this will do is that you will have more opportunity in the coming months, over the next 2 years, for more conversations to happen with those legitimate suppliers, and then also the new build suppliers. What conversations can take place there. So some of that will help patch a little bit of that problem, but it will encourage more conversations. I think the 232 bit will encourage more conversations. So there's that component of it. I wanted to go back to something else you said, just with respect to how you guys are looking at some of the modeling here. We update our models on occasion. I can happily say that we haven't. I'm pretty bad here, Justin. I mean, when I'm running on a operating system that's out of date on my computer, and I rarely update my phone because it tells me to update every day, I don't even bother. So it's probably at least a year old. But in case of our situation, we know that things are very healthy with respect to our investment in the sector, short of broad market crashes, which we've seen. But generally, we have a good idea on a basis of modeling. But you've done more work recently to have an updated model on your guys' side as to how you're seeing the data, and how you've aggregated everything down to the nut, bolt, and screw. Just talk a little bit about some of the findings there that as you guys wrap up. Just talk about how you're seeing things. Typically over here as well, we really don't count anything on the reactor side unless you're within 2 years of 2 to 3 years of actually coming online. We're pretty conservative in our thinking as well. But just tell us a little bit about what you saw, because you already had a very good, clean idea of where this was going. Everybody's been guessing all the time. Even the best, smartest people out there haven't got it right. But what are you seeing? Has this reconfirmed your position on this, or even looks even better than what you thought?
It definitely has reconfirmed our conviction. I can give you just a kind of a general idea about our scenarios that we've modeled out. And our primary scenario, we call the reference scenario, kind of in line with WNA, which is this is the scenario that we feel has the highest likelihood of actually panning out, both on the demand and the supply side. Like I said, there's not a lot of flex in the demand scenarios going out, let's say 5, 6, 7 years. If you go out, beyond that, there can be a lot more flexibility in the demand. On the downside, it's always possible that there's a nuclear accident that slows down new builds, right? That's always a possibility in the background. Fukushima obviously being the main example of that. And of course, that accident in and of itself was bearish for a brief moment in time, but it really was the response of the industry, the shutting down of the Japanese fleet, the eventual shutting down of the German fleet, et cetera, that created a demand shock. So right now, what we're seeing is a very large demand increase going out. And there's particular years where we have a huge number of new reactors hitting the grid. And new reactors, of course, have a 2 to 3x uranium demand in that core load, that first core load. So that primary demand, we have a stagnation in primary demand from 27 to 28, and then a huge jump going from 28 out to 2032. So between 2028 and 2032, we see primary uranium demand going from 218 million pounds to 270 million pounds over that 4-year period. Just an absolutely gigantic jump in demand. And that's what we can model, and that's based on what's under construction right now and what is operating. Every single reactor in the US is getting life extended in our estimation, probably even Diablo Canyon, even though we still model for that to be shut down in 29 and 2030. But who knows if that's the case? It probably will be extended. On the supply side, we model for Kazatomprom reaching that 5,000 tons a year at Budenovskoye. And they're supposedly building a sulfuric acid plant. So are the Russians, both in Kazakhstan. How quickly those two facilities come online will determine how quickly they can ramp that particular project to full production. But we're giving them the benefit of the doubt. Will they on a 100% basis reach 80 million pounds a year? In our estimation, probably not. But either way. So what we see in our model is at the best case scenario for supply, we see an 11 million pound deficit in 2028, and that is the closest the market gets to balancing, as far as we can see in the future. By the time we get to 2035, there's almost 100 million pound deficit, and that includes the operation of Arrow, by the way, at basically close to their full production that's advertised in their feasibility study. Now, Arrow already has been deferred. If you were to look at this project going back 12 months, you would have expected first production in 2028. Now they have their last public, the public review. The last public review will be February of next year, followed by a multi-month period where they would expect their permit to be granted. So let's say middle 2026, when they can actually get shovels in the ground. That means, according to their feasibility study, they will have a 42-month, a 3.5-year construction period. So that puts first production basically at 2030. And so that's a 2-year pushback, just coming from the company's best case scenario optimistic development timeline in 2030. And most people in the industry don't believe that's even going to be achievable. So it's really completely doubled down our conviction for this, because when you look at the numbers and when you put thousands of hours into researching the sector, this is not just spitballing on Twitter and looking at what the spot price is doing today. This is looking at what is the world going to be consuming, and realistically, what will the world be capable of producing? And you go out 10 years, who knows what can happen, right? But you go out 5, 6, 7 years, you can have a pretty strong sense of confidence in what this looks like. Now, just for, let's say, curiosity, we've done a second scenario, which is a flat price scenario. So that is to say, if we don't see prices rise from $65 spot, $80 term, what gets built? And this scenario still assumes that all of these state-owned projects get built, right? So that's anything from the French, the Chinese, the Russians. So Orano's project in Mongolia gets built. Russia's joint venture in Kazakhstan, that definitely gets built. All of the state-owned projects and the low-cost projects. So we still have Phoenix being modeled. We still have Arrow getting built, right? So the low-cost projects and the state-owned projects all get built under this scenario. Well, under this scenario, we have almost a 20 million pound deficit in 2028, which is the closest it gets to balancing. You go out to 2035 and there's a 130 million pound deficit. By the time you get out to 2040, we've got a 300 million pound deficit. And we don't know where those pounds are going to come from. And a lot of people might react to this and say, Justin, that's ridiculous to be thinking that far out ahead of time. The utilities are covered right now. Why does this even matter? Because the utilities are always covered right now. the fuel cycle is a 24-month fuel cycle. And honestly, Andrew, probably right now that fuel cycle is more like 32, 36 months, given what's going on geopolitically. It takes a very long time to run uranium through the fuel cycle. And unless you're buying expensive Chinese EUP, which has limited volume anyways, that's what you have to do. So utilities are covered for the near term. They always are covered for the near term. 2030 is where utilities are looking right now. And coverage for utilities drops off a cliff globally starting around that period of time. So modeling for what's going to be happening in 2030 matters right now. And the utilities, I'm telling you right now, they are making some very, very dangerous assumptions. They are assuming that the pounds are going to be shaken out of spot one way or another. They are assuming that Arrow is going to be selling them uranium in 2030, and they've already had some contracts, 5 million pounds of contracts for first delivery in 2029. They're going to have to revise that because that's not going to happen. They're assuming that supply will respond and it will be available for them. And while I say that this is dangerous to their defense, it always has been. It just is all about at what price. So this market is in a severe undersupply with no price movement to the point where you're not going to get the uranium you need. So this is sort of a hypothetical scenario anyways. We do believe that the industry will find balance. And the only way that's going to happen is with higher prices, because ultimately these utilities have no other option. They have to buy uranium. There's no other fuel that they can put into the reactor. It's just uranium. Technically, could they put thorium with plutonium? Sure, but that's always been the case and they've never done it. So at any price. So this is the scenario we're looking at. We don't see where this balance comes from. And we definitely see we won't even remotely come close to approaching a balanced market without significantly higher prices that incentivize the US to get to 5 to 10 million pounds a year, that incentivizes Etango and Tumas to get built in Namibia. These things are very, very important for a balanced market, and that's not happening at $65 spot, $80 term.
Good stuff there. Yeah, I think overall we've been very comfortable with our thinking as how this plays out. We've always been questionable in the timing, and I'll happily admit, Justin, had you asked me this in 2016, I would have never guessed we would be here having this conversation in 2025. Definitely, we all expected it to happen earlier, but I'm okay. I mean, we've been beat up so much by the natural resource sector, not just uranium. We understand that a lot of this stuff takes much longer time frames than most people have the appetite for. But certainly, there's a lot of stuff that's helping to build yet again that basis for a complete disaster in this market if things don't start to get worked out, and they're not being worked out. You have some assumptions based on when some of these big projects will come online. I'm skeptical of any of these timeframes, very skeptical. Just take a look at the past performance of all the folks who tried to get something online. I mean, I don't think now there is not one company out there that has not been punished. Yeah, there's not one there that's been punished now. Every one of them has been punished. They've all failed to meet their numbers. I think people can expect probably more of the same, more incompetence, more technical difficulties. The fancy presentation deck on the fancy paper isn't working so well, fancy dimension. It's not turning out so well. And so when you look at some of these other ones, you have to ask, okay, well, where are the people that are actually going to build these things? When was the last one of that size built in Canada? What have you? Name your country. So I do think that there's a lot left to be built in terms of problems here for the sector. The fuel cycle's in bad shape, as you well know. You know, everybody's booked out through the end of the decade. The capacity expansions have really been replacements. And then any ones that are new builds, you know, Tennessee, for example, I would say early 30s, but definitely not 2030, you know, 32, 33, 35. So there's lots of stuff that needs to happen there. To me, it's very positive. Other areas, Justin, I wanted to cover off here real quick was the spot price here. We all know that there's constant churn. There's a couple of traders out there. There's a couple of groups that like to move material back and forth to each other for a small clip. We know that happens. So there's always that churn that's occurring. There's a bit of a carry trade that's going to happen here for a while as we continue to see the term price higher than the spot price. So there's a little bit of incentivization there. Then there's the case, we heard a little bit of rumblings out there. I'm not sure, Justin, where it originated. Don't care, because it's something that I think you and I had always thought about, is that there was this promise that we'll never sell a pound. The physical hoarders will never sell a pound. It's going to be put away forever. And, we all know that from a financial sense, that never makes any sense. Looking at this, you have a number of public listed funds out there that are physical holders. You've got some somewhere in the middle, and then you've got, of course, the private holders of physical as well. So you've kind of got this mix of different holders out there that theoretically, either by themselves or in concert with others as a group, could either execute some type of a sale to another group or some type of market transaction, whether it be long term or spot. Any thoughts on just the physical folks out there getting tired? We know that there can be margin calls in the market. Maybe someone's tired. I'm tired of this trade after 10 years or 8 years, whatever it's been. We all know people wrap up and things move on. But just any comments out there about the idea that these funds, whether private or public, can sell a bulk of material to a utility or to a trader to offload their position. Maybe they want to take profits. Maybe they want to move on. Maybe they're sick and tired of the sector. Just in the sense that you and I always knew that this material could become available as the market moves, where it goes as the cycle plays out. And so for me, it wasn't a surprise. And I don't care if someone wants to go sell a couple million pounds or even 10 million pounds to a utility. I don't give a shit. I mean, we knew that that was going to happen at some point. And for anybody who ever believed that these physical folks were going to play the friendly of we're never going to sell a pound, I think was nuts. And I guess I'll add before you start, pick on Yellow Cake, for example. Yellow Cake could utilize their option with Kazatomprom while at the same time doing a term deal to offload some of the existing pounds that they do have with the utility. This is just an assumption. I don't know. Where they sell that material and raise funds, exercise their option in the next year. That's just one example of just doing good business. If you can clip a bit and actually exercise an option, get your material cheaper, that would be like one idea. I'm not saying that they would do that, but let me just also premise this before you go with the fact that the folks who run these things, they're incentivized by fees. They're taken care of, Justin, no matter what the market does. Once you get that holding, once you're paying the storage fees, once you're collecting that management fee, and all the other incentivizations in terms of change of control, what happens if you liquidate the fund, who gets paid out. There's different motivations to do different things. There's motivations to do transactions. There's motivations to collect fees. I mean, the managers are not out anything. The equities can go in the toilet. The managers still get their fee. So they're taken care of whether you're in a bear market or a bull market or a sideways market. Doesn't matter. This was always there. It could always happen. And I'm sure it will happen before this cycle's over, even more than what we've seen. But just any thoughts on, the physicals and someone liquidating in the market, and in the short term, someone might care, but I don't care because we're looking at this longer term. So what are your thoughts there?
So I suppose I would start off by saying that the physical pounds that are held by hedge funds are probably the most liquid in terms of funds holding physical material. So that would be, Goldman and various other funds that do hold physical uranium. And some of those funds did do some de-risking to end last year and to start this year by selling some material into the spot market, which did have some downward pressure on the price. With that said, have they been buying and been nibbling again? That's what my understanding is. So these guys will trade. Now, if we have a full-on absolute market crash where we're not talking the S&P is down, 3-4%, but over the course of a month or two, down 10, 15, 20%, and liquidity event, let's say, could we see Goldman and other funds sell uranium in order to generate some cash in that environment? Absolutely, that's possible. But that's a smaller amount of uranium, especially in the big picture, right? I think hedge funds probably hold somewhere between maybe 10 and 15 million pounds total, and probably on the lower end of that right now because of the selling that did happen over the last 4 or 5 months. Moving on to Yellow Cake and Sput, sort of two different scenarios because one is a fund and one is a trust. Now, Sput is absolutely, the way that they are similar is that they both have a mandate to hold uranium. So these are not trading vehicles. Sput will not be engaging in contracts selling uranium. Now, recently, John Ciampaglia, the CEO of Sput, did come out and say that they may have to sell a small amount of uranium or possibly do location swaps, because right now, actually, let me bring it up in the background here. There's a location spread of, let's see, oh, it's not that much right now. It's only 50 cents between Cameco and ConverDyn. It was $1.50 about a month ago. But he had talked about maybe doing a location swap and generating some cash, and they can still do that. But they might have to sell 50,000 pounds here, 100,000 pounds there to generate cash, because they have been unable to raise cash because they've traded at a persistent discount. They haven't raised cash since January. They haven't bought uranium since November. So they might have to sell a small amount of material to raise cash just to keep the lights on, let's say. But that's not a meaningful amount of uranium. We had 1.6 million pounds trade in the spot market last week. So to sell 50,000 pounds or 100,000 pounds every 6 months or something to keep the lights on, let's say they never trade at NAV again, if that's what they have to do, so be it. It's not going to have any sort of effect on this market whatsoever. Could somebody technically buy the Sprott Physical Uranium Trust and therefore free up those pounds? Absolutely. And that's also the case with Yellowcake. But that would actually require a shareholder approval. I believe it's a 2/3 unit holder approval for SPUT in order to accept a bid. And you can imagine somebody bidding for 62 million pounds is going to be an enormous, enormous market event in this particular market. And we don't see that happening until we're at, I mean, who knows what price point we'd be at for that to happen. That's the kind of thing that could happen if a utility literally cannot find the uranium that they need in the long-term market for a certain period. So if and when that happens, already we're probably at a point where the equities have doubled or tripled or more. So that's not really something to fear. There has been a rumor recently that a fund, a quote unquote fund with quote unquote more than 15 million pounds, I'm not going to say who came out with that rumor, but there's only one fund that has, that amount of pounds that isn't SPUT, and that's Yellowcake. They've got 21.7 million pounds, something like that. There was a rumor that they would be selling that uranium or could be contracting uranium, and Yellowcake has absolutely refuted that rumor. Now, Yellowcake can sell uranium in order to raise cash and execute, as you mentioned, that option with Kazatomprom to buy uranium. They could technically buy back shares and pull them up closer to NAV. Those are all possibilities. They haven't done that in a while. In years, they have not done this. So they refuted that rumor. And just like SPUT, they have a mandate to hold uranium. Will those pounds eventually shake out? Could somebody actually take over Yellowcake and free up that 21 million pounds? Yes, they could. But that would have to be a bid, an enormous bid that the shareholders would also have to approve. And supposedly the response from Yellowcake to that rumor is that there's no way we would be doing that right now after the price has come down 45%, the spot price. So this is a later problem when the price is much, much, much higher and would have to have shareholder approval to take over the fund. Will they sell a smaller amount of uranium sometime in the future to either raise some cash to buy uranium? I mean, that's a little bit strange to sell uranium and raise cash to buy uranium, because they'll probably be at the same price that they would sell it at. But could they buy back shares to get closer to NAV? That is always a possibility. So all of these things, Andrew, I see as future problems. There's no messaging that I've seen from Yellowcake or SPUT that they are tiring of this investment. They tend to have a much more professional and longer term vision for these vehicles and for this market than most of the retail people that are worried about these things happening. So, those are pounds that will they eventually shake out? Maybe, if they are bought by utilities, and the utilities are not going to do that in bulk unless it's at a significant premium to the market. And that is not going to happen until we are in a period where the market is so incredibly thin and the price is so high that it makes sense to do it. So I'm not concerned about this whatsoever. We go 2, 3, 4 years down the road and we're at $150 to $200 uranium. I don't really care if they sell that material. We're probably going to be not necessarily out of this trade, but we're going to be happy and sitting on incredible gains. So not really a problem, and definitely not a problem right now.
The longer the problems go on, the less meaningful these total aggregate amount is going to be. So
Absolutely.
when you look at what's happening out there, I mean, £15 million in the big scheme of things, that's not a meaningful amount. I mean, look, it's a lot of money for sure. And to somebody, it's meaningful. There's no doubt, especially the transactors. But, as this goes on with the problems we're seeing in the supply side, Justin, I think this becomes less and less of an issue. It makes a lot of sense to take a look at maybe a term contract if you're wanting to move something off, if you're a private holder or something like that, if you can sell some of it off. And of course, the trading component of it as well. Just with respect to the public ones, most of the incentivization is the fees. I would completely understand to see Spot have to sell a few pounds to cover just their storage fees. I mean, Cameco's raking it in. It's a good business. Their management fees, it's along the Sprott model of the other trusts. It's a fee collection system. It's not my flavor of the day, but apparently for some people out there it is. But certainly it's a profitable venture. It's a long-term venture for them. What's the big issue here? It's not really a big issue to me because we're looking at the market differently, and we know we're playing in the equities, and of course we know the issues on the S&D that make this generally not a big deal. If it is, it's a blip. Everybody freaks out for a few months, and the equities sell down. So what? We've seen that 5, 6, 7 times before. So not a big deal there either. But there'll be opportunities. So I think that that's the important piece of it as well. Anything on the company specific side, Justin? Any other stuff you wanted to cover maybe on the company specific sides, maybe a segment of the market that you are liking more today over maybe a different segment, like, exploration is not as good as maybe looking at the near term development companies. We know people's a huge thing out there. We've got people shortages. Among the people shortages of competent people, we've got slime balls out there also causing further disruption in the people side of things in this market. People is always a big issue no matter what segment we're talking about. But just any comments as to where you think investors should look in terms of developed cos, cash flowing cos, maybe royalty companies, fuel cycle companies. What's maybe a couple angles you think would be viable for this next leg up?
I honestly think what we've just gone through, and not necessarily calling a bottom here or saying that broad market volatility is over, but we've just gone through a period, this last 6 weeks or so, let's say, is the type of market that I would call a nobody cares about anything market. And I've seen this a few times since I've been following this uranium market. And the time that really stands out in my mind is late 2019, early 2020, when ISO Energy was getting these massive hits at the Hurricane deposit. I remember even, I think it was January of 2020. And of course, this was when COVID headlines were first starting to come out, and the market was still going up and up and up, but it was starting to teeter, and nobody cared. And the uranium price had started to recover since 2016, but the equities basically went sideways to down from 2017 to 2020. And so it was this period where everybody was just throwing in the towel. Nobody cared at all. And they had these, crazy, it's incredible 50% uranium in like 10 meters or whatever it was, just these monster drill hits. And I remember looking at that going, oh my God, nobody actually gives a damn about this. And that was an incredible opportunity at the time. And we just had, similar things happen. We had Kazakhstan announce that they're considering a sovereign uranium strategic reserve. They want to build a couple of reactors and they want to start hoarding uranium. And that news came out 2 weeks ago and it did absolutely nothing. Nothing to the physical market, nothing to the equities. There's a couple of explorers that have been hitting nice intercepts and the stocks are doing nothing. So it's hard to say exactly what anybody should be focusing on here because everything has been thrown out. And generally speaking, in my experience, what I have personally done when the market gives you opportunities across the board is I buy quality with leverage. And I don't recommend anybody doing this, but I like to take options positions on the quality liquid stocks. And these are usually the large caps. And then that's what I do. I free up some cash via my diversification or the cash that I had going into that period of time, and I get levered long into some options trades on large caps. That's just me personally, and I'm not recommending absolutely anybody do this because if you don't have the experience or don't know the options market, just please stay away. That's the best way to lose money. With that said, honestly, things are moving in a direction and very quickly today of being supportive of the US. Now, the US used to be the biggest uranium producer in the world back in the 1980s. And there used to be multiple mills. I think at one point there were more than 10 uranium mills operating in the country. Right now there's one. That's Energy Fuels White Mesa. There's a couple of others that are kind of buckets of rust that might be able to be revamped, but is what it is. The United States is going to produce probably between 1 and 2 million pounds this year, and the US nuclear fleet will consume 45 to 50 million pounds. I think that all of the signs are there that the Trump administration is doing, whether or not you agree with how they're doing it, they're putting focus on nationalism and being a secure nationally in terms of our domestic needs for minerals. And the 232 investigation is one element of that. So I'm bullish U.S. miners, U.S. uranium miners for sure. And I think, and I'm not the only one, I think that there's a lot of people looking at that. But with all of that said, when we had a good leg up in late 23, early 24, with a continuation of price, we expected to see rotation out of the large caps and into the developers. And that didn't really happen. So the small caps have been thrown out to a much greater degree than the large caps. So if you can look at URNJ compared to URA or even URNJ has been crushed. I think there's huge opportunity, especially for these small caps, but I wouldn't want to speculate on just one or just two. Unless you've done an enormous amount of work and have extremely high conviction in those particular companies, better to own a basket. Why not just own the ETF? URNJ is basically URNM with no Cameco and no Kazatomprom, and it has some added juniors with lower market capitalizations and less liquidity. So I think there's huge opportunity in URNJ and in the small caps in general, but really this is one of those buy anything kind of periods because everything's been crushed.
Good stuff there. Certainly for the options folks out there, you got some options ideas. Generally a little bit of a mixed basket in the sense of more focused towards the mid-tiers developed codes and into some of the, I guess, special situations / explorers that would make sense to me. As you know, Justin, we've never been a fan of the ETFs just because we'd rather put together our own set. And I know you, in your research as well, stick with your own company research, and you might have a few other options and different things going there. But generally, we like to assemble our own baskets and go with that. But certainly for the folks that are new, that might be here for the first time, maybe an ETF makes more sense to get started as you continue to do research. And you could dig into the ETFs and see what they hold, and then maybe start with some of those, and then work it from there. Of course, for us, a lot of it continues to be looking at different financing opportunities out there and what can make sense from that standpoint, depending on where the company is, how much they're raising, whether or not we have warrants, and what the fuse is on those warrants. So that can certainly make some sense as well. I think on this next leg, whenever that does occur, Justin, I do think we'll see a lot more funds flow into the lower tiers of this market. And I think that's where the real torque will be before it's all over. Any other stuff you wanted to discuss before we wrap up? I want to give you a chance, of course, to talk a little bit about your newsletter, but we'll do that just at the end, Justin. But was there any other areas of the market that you wanted to cover off here before we wrap it up?
We've covered it pretty well, Andrew, and yeah, I completely agree with what you just stated. If you have a focused basket of some choice equities, you can absolutely outperform the ETFs. I would just say make sure that if you're listening to this, that you do your work on those companies, because taking larger individual company risk is certainly something that's going to add volatility to your portfolio. But we've outperformed the ETFs with our focusless portfolio, and I know that you have as well. So I completely agree with you there. As far as what to focus on here, I really think this next leg, whenever it starts, is going to be a very, very large move for this market. Look for confirmation in the physical market. That's the best advice I can give. And I hate to say it, it's the spot price is what everybody watches. And I'm not going to be the voice out there that says the spot price doesn't matter, because it absolutely matters. We have a lot of term contracts that are referenced to the market at the time of delivery. So, and the spot price is what is most visible to investors because we actually have daily reports on the movement in the spot market. But it's not where the volume is procured. So while the spot price has the largest influence on the equities and influence on investor sentiment, the term price is telling the real story. And that's something, it really can be that simple. So throughout all of this volatility that we experienced over the last 3, 4, 5 months, what has the term price done? It is rock freaking solid, despite low volumes, despite an utter lack of demand in the long-term market. The price is holding steady. That should tell you absolutely everything you need to know. As far as what we cover in Uranium Insider service, we have a small team that's dedicated exclusively to this market. What we focus on most is the physical market. We put out a weekly uranium market report where we actually discuss the volumes and the price movement in both the spot and the term market with some detailed analysis of what is happening in those markets. We share in our monthly letter with our newsletter members, as well as in daily updates and weekly chart review. We cover what is going on in the physical market. You want to know what is happening there if you're invested in this sector. So over the past months, when the equities have puked out, 30% in the last, 6 or 8 weeks, knowing what is happening in the physical market will give you conviction to either, if you're all in and you're just hanging on, will give you the conviction to hang on, or if you have had some dry powder, to put it to work. Because the physical market, while it is quiet right now, the price has been stable. And when you understand that when demand absolutely pulls back from both the spot and the term market and the price stays firm, and when a little bit of urgent demand came into the spot market, the price went up $2 or $3. Those are signals that you want to be aware of. Those are signals that we make our members aware of so that they can make their own investing decisions. So that when the broad market is puking out 5, 6%, the uranium equities were down 7, 8%. You had dry powder to put to work. What's happening in this market? When is it going to move? These things are really, really important to know. So we cover the physical market very thoroughly. We've done thousands and thousands of hours of work into our modeling to give us conviction. Our members, we've done deep dives into our modeling that our members are able to see all of our assumptions into these models and what exactly goes into those calculations to kick out the graphics that we've shared. So knowing that we're doing the work in the background and we're sharing with our membership the important elements of the physical market, that's really what you have to understand. And yes, markets will go up steeply and down steeply. It's extremely volatile. We always recommend having an appropriate allocation to the sector based on this outsized volatility. You don't want to put all your eggs in one sector. You want to diversify. You want to keep some cash on hand basically at all times. But with all of that said, if you have a strong take on what's going on in the physical market and what will happen in the physical market, and we have a very high conviction of what will happen there, then you can act appropriately with your investments in the space. So that's really our focus, Andrew. That's what we put the bulk of our efforts into, is keeping tabs on this physical market and making sure that our members are aware of what's happening there.
We like your service. You've been around for a number of years, and like us, you've also been attacked over the years too. And there's always painful moments, and we no doubt have those, all of us, even though there's some people out there that would never admit it, and they've always been perfect on this trade. There's certainly a few out there that you can listen to that'll tell you that. The reality is none of us has been perfect. Everybody's made mistakes in this trade, and we've all at some point lost money. And I think at this point, if you've been in here the entire time, you've certainly made money. If you haven't, you probably might want to reevaluate how you're going about it. But one of the biggest things I think we've had trouble with, Justin, over the years is you really can't transfer that knowledge or that, you can use the word conviction, but the data is the data, and based on the data, you're able to make decisions. You're firm in your understanding that that decision is a sound decision. Call a portion of that conviction or what have you, but aside from the conviction, you have the data to back up why you're doing what you're doing. I think all of that's really super hard to transfer, because if you try to transfer it in writing, people just look at it as marketing. And there's a lot of that out there that does that, especially in the junior sector, not just uranium. But definitely, I think as a guide, it's a good service. And just like, I'm not going to pitch SmithWeekly here. We have a different style and approach, but it is a guide. And to have some people that are kind of leading the way, that have been in the market for the period of time that you're talking about, you've got a very good handle of the situation and the data to back up what you're doing. I think that's very useful to people. And so, I mean, it's never perfect, but I do think it's a very viable service to take a look at. And of course, we'd recommend folks get it. I get a copy myself and read it from time to time, Justin, what you're doing out there and a lot of the work you're doing, because you spend a lot of time on this, just like we do. I don't know where we are on total hours of the day, but it's in excess of probably 12. Some of us are 14, 16, 18, but definitely encourage folks to take a look. Justin, as part of that, how they can reach out to Uranium Insider to get further information about the service. And then also, you might just remind folks while you're here, what are the different levels of service and what the price is.
Thanks, Andrew. Well, I really appreciate the kind words and the advocacy, and I'm very grateful that we've been able to connect and stay in touch over the years. And you were actually the first interview that I ever did, which I believe was back in 2019. So thank you for that, and thanks for the supportive words as well. And I'm a big fan of your service as well, and can't recommend it highly enough to anybody who's listening. So keep up the great work. And to echo your point, absolutely, conviction cannot be borrowed. It just can't. You can get stock tips from Twitter. You can look at a chart and you can make a bet, and we've all done that. And I've had winners, I've had losers based on borrowing somebody's conviction. But you really can't. And the only trades that I've really done well on that are outside of the uranium space have typically come from services like yours. And I subscribe to, I think, 3 or 4 other newsletters. And I know that those people are doing deep work on various sectors. And when they have recommendations, I generally feel much stronger about that, knowing that somebody that I trust is doing much deeper work, because none of us have enough time to research every sector that we're interested in to any meaningful depth, and that's just the reality of it. So being able to do this work on behalf of our membership is something that I feel very honored to be able to do, and thank you for all of the kind words and for your support over the years as well. We can be found at uraniuminsider.com. I also have a decent presence on Twitter or X at Uranium Insider, although it's been less recently because the spam bots are out of control. So I mainly go there for news, and I'll repost some things, but not a lot of posting there. But I can be reached there if somebody wants to connect on that platform at Uranium Insider. But yes, uraniuminsider.com is our website where we can be reached.
Encourage folks to at least take a look. Send Justin some questions about how the service works, besides what their website's showing about how it works. Yeah, Justin, appreciate it as well. It's been a rough and tumble number of years. And of course, we're not just in uranium over here. We've been always exposed to copper and gold and what have you out there. So a few steps back in certain sectors, a few steps forward. And we've always had that kind of thought. And it's really a people network based system. And we come across opportunities generally by talking to people. And, that's why we've kind of stayed exposed to that. And I know a lot of folks out there, we are fairly quiet, short of the podcast. We're fairly quiet these days about things. And part of that's a factor of time. And then also just don't have the capacity to be dealing frequently on social media anymore. And so that's kind of where we kind of hang our hat on things. And it's always been a pleasure. And hopefully we'll have you back here maybe later on this year. We'll see how the broad market sorts out, and then see how the uranium market sorts as well. And I'm sure we'll have some stuff to talk about later in the year, and really appreciate your time today.
It's absolutely my pleasure, and keep up the great work. Thanks so much for having me on, and look forward to staying in touch.